There are many different approaches to managing Condor spreads. While we can't tell you which technique is the best for you, we can introduce you to multiple management techniques and discuss the pros and cons of each approach so that you can make an educated decision about what style you're going to start with. The most important rule to remember is that no matter what rules you've set up, unexpected things can happen, and you should always position size as though you could lose the entire amount you have at risk in a trade. Since Condors are a limited loss, limited reward type of trade, management rules should be straightforward and simple. And because Condors are just two vertical spreads put together on the same stock, the rules should be basically the same as you use on vertical spreads. There are three exit points that you need to have rules for: an exit for a loss, an exit for a profit, and a time-based exit. Well, let's talk about loss management first. There are two basic approaches to loss management that we want to introduce you to here. The first is to just simply risk it all. The benefits of simply risking it all are that you don't have to worry about the emotional side of the loss-taking process. And even if the trade goes against you, you can stick it out to see if it'll come back. There's no wondering whether it's time to take a loss or not. Because you started the trade by saying that you're willing to risk it all, you can just let it go to maximum loss if you want. Keep in mind that just because you said you were willing to risk it all, you don't actually have to risk it all. If at any point during the trade it becomes clear that the trade is not going to be successful, you should pull out and preserve whatever funds you have left. The downside to just risking it all is that it can lead to a single losing trade completely wiping out a lot of winning trades. For example, if your typical trade has a return on risk of 25%, that means you're risking $4 to try and make $1. In other words, the losing trade in that scenario could wipe out the profits from 4 winning trades. You'd have to have an 80% success rate just to break even. The second approach to loss management that we want to introduce you to is based on the strike you sold. For a Condor to be successful, the stock has to stay in between the strikes of the options you sold. For example, if you placed a bull put spread with a sold strike of $50 and a bear call spread with a sold strike of $60, the stock needs to stay above 50 and below 60 for the trade to reach maximum profitability. In this technique, we simply set a rule that says if the stock closes outside of either sold strike, I'll exit the trade for a loss. So in our example, if the stock closed below $50 or above $60, we would exit immediately. There are two key benefits to this approach. First, the probability of losing the maximum amount on a trade is much smaller than the risk-it-all approach. Second, you're following your original analysis of the stock you're trading, and you're allowing yourself to admit that a trade is a loser. This enables you to free up capital from a losing position and redeploy it elsewhere if you choose. There are a couple of downsides to this approach as well. First, you don't know exactly how much you'll be losing if the stock crosses your sold strike. There's just way too many variables in option pricing to try to forecast that. The second is that, of course, there might be a chance that the stock could come back. Remember though, your primary concern as a trader should be controlling your risk first and foremost. It's awfully hard to generate profits if you run out of money to invest after all. What about managing profitable trades? There are a few approaches to this that we'd like to introduce you to. One common approach, by newer investors especially, is to simply let profitable trades expire worthless. This sounds good in theory, because you collect 100% of the premium you received, and you don't have to spend commissions to get out. This approach, however, is deeply mathematically flawed. If you practice it too long, you're likely to lose more money than you make in the long run. The problem comes, as we've mentioned before, in the twin forms of diminishing return on risk and increased exposure to maximum loss potential. We discussed the increased exposure to maximum loss in detail in the gamma risks video, but to put it simply, the closer you get to expiration, the higher the chance of experiencing maximum loss in the trade. Another approach to setting a profit target is to select a consistent percentage. For example, many traders try to target 80% of maximum profit before exiting. Some traders prefer to get out quicker and maybe they'd set a lower profit target, such as 50% of maximum profit. Another variation of this technique is using a tiered approach to exiting. For example, you could divide a trade into 4 time periods or quadrants. For a 1 month trade, that would mean 1 week is one time period. After 1 week, if you'd profited 50% or more, you'd exit. After 2 weeks, exit at 65% or more. After 3 weeks, target 80%. This approach takes into consideration not only how much money you could make, but also the time frame over which it could be made. At this point, we've covered a couple of different approaches to managing a losing trade. We've covered a couple of different approaches to managing a winning trade. Now, we need to cover a time-based exit strategy. It's a really good idea to consider minimizing your risk by setting a deadline for exiting a trade no matter what. A common approach is to exit 2 or 3 days prior to expiration at the latest. This dramatically minimizes the likelihood of maximum loss in a Condor and also minimizes the likelihood of early exercise. Always remember, anytime you sell an option, it's possible for you to get exercised. As I said, not holding through expiration greatly diminishes that risk, but doesn't eliminate it entirely. In the event of an early exercise, don't forget, you can exercise your long option to cover your risk if needed. If you hold through expiration and your sold option gets exercised, you are liable for the risk of the stock position. If you have any questions about exercise risk, please don't hesitate to call and speak to a broker. There are many variations you can use when managing your trades. We've only covered a few here. Well, now that we've introduced some basic management techniques to you, feel free to write some rules down. Paper trade them, make sure they work for you, and adjust as necessary before implementing them with real money.